and welcome back to another edition of Lipper's Fund Flows Insight. My name is Matthew Lemieux. We're going to be reviewing weekly fund flows for the week ending October 31st. And to say it was a wild ending to October, I think would be a little bit understated. The East Coast saw one of the worst storms on history batter its shorelines, closing down the financial hub and most markets in the U.S. basically on Monday and Tuesday. It was the first time 2 days consecutively the markets have been closed because of weather since 1888. And on top of that, once we finally got the markets back open on Wednesday, we closed the month out down for the markets, and this was the first time since May of this year. We looked at the Dow Jones down 2.5%, S&P down about 2%, and NASDAQ really taking it on the chin for the most part, down about 4.5%. So overall, we're going to be looking at flows for just basically Thursday, Friday of last week, and then the Wednesday month close for this week. And as we'll talk about, we'll see a lot of what it looks like a lot of lower volume when it comes to the flows that we've seen traditionally. So let's take a look at really how all this news played out within the flows. And if you look at the overall picture, we see a lot of red. Actually, overall, the conventional mutual fund business, excluding ETFs, saw about $26 billion in outflows. As you can see, the vast majority of that came from money market funds at $23.5 billion. But overall, we continue to see equity struggle, $1.4 billion. And then a bit of a surprise from what we've seen over the last several weeks, we'll talk about more, is we see taxable bond funds pushing just about $900 million out the door, and municipals also seeing an outflow for the week of around $200 million. So again, a lot of red, based on a lot of lower volume, not just in the trading markets, but on the buy and sell side of mutual funds and ETFs. So let's take a look at equities in general. We said $1.4 billion out. Realistically, not that surprising, just because we've seen the fluctuations, especially on the mutual fund side, where equity funds have really been, the story has been outflows. If you look at it, this is the second consecutive week of outflows for this group. And once again, if you look at kind of how we split it out, domestic really is the culprit, $1.4 billion out of that. If you actually look just at domestic, this is the 15th consecutive week of outflows for that group. So U.S. diversified equity really has continued to struggle when it comes to equity mutual funds. Non-domestic equity bought at about $70 million, so very low. Actually, if you look at the year-to-date numbers through this last week, we see about $52.1 billion in outflows for equity mutual funds, so continuing to struggle. Let's take a look at the other side of that group, though, which is going to be the ETFs. Again, a lot of times we've seen that this is a different story, and once again, it rings true this time. About $1.3 billion into ETFs. This is after 2 weeks of outflows, so they were able to break that streak. And if you look at that pinned versus mutual funds, of course, it looks somewhat like a wash. But it looked like investors really, on this end, maybe making some last-minute tactical moves. If you look at SPY, we saw about $1.1 billion coming in this week, and I looked at the numbers on a day-by-day basis. The vast majority of this came in on that Wednesday month-end close, so we could have been seeing some little bit of window dressing for some fiscal year ends for some people at the 1031 basis, or just kind of trying to clear out the month, put a position in there, $1.1 billion. But if you look at the broader markets, some of the other products, PowerShares Triple Q had about $140 million out. And the Spider DJIA, Dow Jones Industrial Average, had about $215 million out. So again, very, very small moves on the most part. We saw SPY the biggest probably move of that whole group. Let's go on to the fixed income side. If we look at mutual fund fixed income, as we said before, a little bit surprising, about $900 million out for the week. This is the first week of outflows in 17 and only the fourth week so far this year. But again, not to panic. It doesn't seem like a lot of these moves really are based on any change in sentiment. What it was is we've just saw a lot less participation in the markets. If you look at the actual underlying numbers, we still saw some inflows, international and global, $109 million. That was really split between what we call global income funds and emerging market debt income funds, which have got a lot of interest of late. But just to throw that number up there, if you look at one of the groups that's been most active, investment grade, $8 million of net inflows. If you look at some of the bigger names in that group, really just no movement up or down either way. So very small trading. High yield, we did see $565 million go out, which not really a big surprise. Again, we talked about the October being the first month of negative performance since May. At the end of the month, we started seeing a lot of weakness, mostly coming from disappointment, I think, in earnings reports. And so high yield probably kind of following the case with some of this weakness in the equity markets, $565 million coming out of that group. Okay, let's go over to the fixed income ETFs. Last week we saw numbers like around 120 out. This week still pretty flat, about 300 million in for ETFs. Again, if you look across the board, no big moves really one way or the other. Similar to the mutual funds, we did see about $1 billion come out of high yield products, specifically HYG and JNK, but those are mostly offset by some inflows, about $1 billion going into LQD, which is the higher quality investment grade corporate. So really, again, not much movement, not as much participation within that group as we've seen. 3-day week and plus all of the other situations going on, not that surprising. Third group we're going to look at is muni debt. Again, another surprise here, as we had said, we saw about $200 million come out of this group. First time in 28 weeks that we've seen an outflow. Again, we don't think it's part of a broader trend, just less participants out there, more sellers than buyers. Maybe the psychology was that more people really wanted to get in at month end to sell, and they would wait till maybe the market seems to kind of pick up and things worked out before they came in and buy. If you looked at it, about, I said 100, well, it comes out to about 160 million in outflows. If you look at the split national munis, 91 million, but the subgroup of that, which almost all the outflows were, high yield muni at $92 million. So again, maybe some investors really kind of just jumping out of their high yield positions before month end. Really no broader news that would basically change our direction than what I would expect going forward in the weeks to come, as we'll start seeing, again, stronger inflows into that group. So this leads us to our last group, which is money market funds. As I mentioned before, we saw $26 billion out of the conventional mutual funds altogether, 23.5 of that just with money market funds. And you know, we've seen a lot of volatility in this group, but still $23.5 billion, even though it's still not a large percentage of total assets, a big move. And so we kind of were trying to figure out what was going on with that. We looked at the split below, and $24.6 billion out of institutional, with actually $1 billion coming into retail. So it looked like the institutional really drove this outflow. It's hard to say that it was a lot of money getting put back to work in the market, because we really never saw really a semblance of offset within our other asset classes. So some of the thought may be we come into the fiscal quarter end for some funds, we're coming to month end, we have some tax deadlines out there, maybe some of this money's going towards those, possibly other liabilities, or maybe there were some investors out there where they saw the storm coming in and they saw the potential for a disruption in the financial markets. They just went out and grabbed cash while they could. Basically, have that liquidity now. If you need to put it back, you've got that ability later. So overall, red across the board, running off of a short week. Even though Wednesday markets were open, I still think a lot of participation was pretty low. We did see yesterday volumes up a little bit higher, and we saw positive markets this week. We're giving a lot of that back. So I think investors are still trying to kind of anticipate the presidential election. I also think they're trying to kind of get their hands on the effects of this storm and the shutdown and whatever else is going on in the East Coast right now for that point. And so we'll see, I think, a little bit of timid moves within the market until after the presidential election. We also have to finish earnings report season. We've seen that even though we're not really quite keeping pace with earnings beats, it's not as bad as thought, but if you look on the revenue side, we've got a lot of concerns there. So we'll have to kind of finish out the earnings season to see where we go. If you'd like to take a little bit deeper dive into the information we talked about, you can visit our website. It's www.lipperusfundflows.com. Give you a chance to maybe sign up and look at the data a little bit more granular, or some areas that we didn't cover. Otherwise, you can join us next week. My name is Matthew Lemieux again, and thank you for joining us, Lippers Fund Flows Insight.